For more on the retail climate in Hong Kong, we're joined by Anthony Chan. He is the chief economist at Chase Private Client and a member of JP Morgan's Global Investment Committee. Anthony, good to see you as always. So Anthony, not a very good year for the retail sector in Hong Kong. 12 months of consecutive sales declines. It's on track to be the worst retail year since 2003 when the SARS pandemic broke out, to put that in perspective. One of the factors is fewer tourists from the Chinese mainland. What are the reasons that they're not coming to Hong Kong?
Well, there's one quick reason. Many years ago, I've been going to Hong Kong for a couple decades. And today, when you go to Hong Kong, if mainlanders go to Hong Kong, many of the products that they used to only see in Hong Kong for the very first time or maybe exclusive, now many of those products are sold in the mainland. So that's less competition. On top of that, we know that the Chinese renminbi has actually depreciated a little bit against the US dollar. We know that the Hong Kong continues to peg to the US dollar. So they're getting a disadvantage even on the currency. So that's another negative on retail sales.
The luxury sector has been particularly hard hit. Sales of watches, jewelry, down about 25% year over year. How much of this is linked to the government's anti-corruption drive?
Well, I think that certainly people don't want to be ostentatious in this kind of an environment where you are anti-corruption. That's true not only in Hong Kong, but that's also true in the mainland. So we are seeing that sort of a shift. We're seeing less activity in Macau. All of those activities that require extra money are in fact being somewhat discouraged. And so that should not be surprising, but that's not unique to Hong Kong.
Are the Chinese mainland tourists that are foregoing trips to Hong Kong focusing their travel destination in one area in particular? Is there somewhere else that they're going to instead?
Well, I think it's very obvious. They're going to be looking at those areas that have seen their currency depreciate. Of course, the country that comes to mind, certainly at the top of mind for mainlanders, is Japan. We've seen that the Japanese yen has depreciated against the US dollar. So that's giving them an opportunity. We're not seeing that with Hong Kong.
So the currency exchange really a big factor here in the tourists' minds. Anthony, with the retail sector being hit, obviously that's going to have an impact on rentals and an impact on the commercial property sector. How big of a significant dent do you think it's going to have on commercial property in Hong Kong?
There is no doubt that if business activity is slowing down, it's going to have a negative impact on commercial real estate values. So far, on the residential side, we continue to see very high prices. Housing prices are very high. Given the fact that that has been a very hot sector. But in terms of the business sector, that absolutely will have a negative impact.
Well, Anthony, yes, housing prices have been high, but according to Bloomberg, the rate of appreciation has been slowing down quite drastically to the slowest level in about 25 years. And as you mentioned, Hong Kong, very hot property sector, up there with London as an overvaluated sector, according to many banks, Deutsche, UBS, just to name two. Do you foresee a big correction then? I mean, these banks have been warning that Hong Kong could be headed into bubble territory for a while. What is your outlook?
Believe it or not, in this kind of an environment, if the Hong Kong dollar eventually moves to soften or perhaps adjust its peg, you will see a little bit of an adjustment taking place, no doubt. But for now, they're holding tight to that peg, so we're not likely to see a dramatic change. In terms of the accumulation, it's not a surprise. It's been a very hot market, and so we're going to see things slowing down, but it's from a very high skyscraper price.
So you're still bullish on the Hong Kong residential sector?
I don't think you're going to see those kinds of appreciation, but I'm not likely to see a complete collapse overnight.
Well, Anthony, one of the things that's been interesting is how the Hang Seng has been performing. It has largely mirrored the Chinese mainland market, the Shanghai Composite for one. Not as drastic in terms of decline, down about 10% year to date. Now, while the Shanghai Composite is not really an accurate reflection of the Chinese mainland economy, it's not really seen as a barometer. Would you say that the Hang Seng is more reflective of Hong Kong's economy?
Well, I think it certainly moves a little bit more closer to reflect the economic fundamentals. But these equity markets are high-flying markets. Obviously, the Shanghai equity market, if you look at the last year, for example, you saw the second quarter, you had the Shanghai equity market up 109%. The economy was growing at 7%. And now, of course, it's down on a year-to-date basis. So it clearly doesn't reflect the fundamentals as well as many other markets, including Hong Kong, do of the overall economy.
Still, this retail sector slowdown quite significant. What action should be taken?
Well, it's not a question of necessarily what action, but what is likely to take place over a long period of time. Given that a lot of the people that participate in the retail sector are from the mainland, at some point in the future, Hong Kong might move to consider to peg their currency not necessarily just against the US dollar, but perhaps even the CNY. Now, the drawback of that they want to do that when that currency becomes fully convertible, and it's not there yet, so they probably have to delay that. But I think over a longer term period of time, if it moves towards the CNY and that currency is fully convertible, then I think it's going to be much, much better for Hong Kong.